Welcome to Understanding Markets. This is your update for April 2024. Let's begin with a review of economic activity. Starting with the medium-term perspective, we see that we have more than fully recovered from the COVID drawdown, and the economy is growing at pre-COVID rates. Zooming in just a bit to the quarterly growth rate picture, we see fairly consistent growth over the last few years. And the most recent survey of professional forecasters indicates expectations of similar growth moving forward. For a more up-to-date forecast, we turn to the Atlanta Fed's GDP Now metric, which predicts Q1 2024 real GDP growth coming in around 2.7%. As an important input to production, the labor market can also provide a timely read of current growth prospects. We turn to that now. The Kansas City Fed provides an aggregate metric meant to summarize the labor market conditions. The latest read there suggests a steady and healthy labor market that is moderated somewhat from the burst of hiring activity over the past few years. As shown in the chart, the level indicator remains positive, whereas the momentum indicator is roughly neutral. Turning to more granular statistics now, we see strong labor force participation among prime age workers. The official unemployment rate is 3.8%, which is slightly above the recent low of 3.4%. That was a nearly 50-year low. The past year shows a nascent trend higher. However, the unemployment rate is still extremely low, historically speaking. Examining recent results from the JOLTS survey, we see that job openings have come down from their historic high in 2022, although they're still well above levels of previous years. Quit rates, which tend to follow job openings, shows a similar pattern. Both reinforce the conclusion that while the labor market has softened somewhat, it is still very healthy. So, our examination of growth forecasts and labor market conditions suggest a continuation in the pace of economic activity moving forward. Now let's turn our attention to prices. Here we see both headline and core inflation levels for both CPI and PCE spending baskets. Evident in both charts is the rapid acceleration of inflation post-COVID and its subsequent fall following the Fed's tightening of monetary conditions. Year over year, core CPI is at 3.8%, and core PCE is at 2.8%. With both growth and inflation covered, now we can turn to monetary policy. This slide lists the Fed's three core mandate objectives: maximum employment, stable prices, and moderate interest rates, and the high-level economic metrics aligned with each. With unemployment sitting at 3.8%, the employment mandate is well satisfied. Indeed, at these levels, the Fed likely believes there is still slack in this portion of its mandate to better achieve its other goals. Inflation has been the Fed's primary concern over the past couple years due to the rapid inflation that followed the end of COVID. Looking at the Fed's preferred inflation measure, PCE inflation, the year-over-year value is still sitting a fair bit above the 2% target level. Keep in mind that the target is a long-term target, so if we look at the 3-year value, we actually see a 4.4 annualized figure. How the Fed will net that against the preceding years of below target inflation is difficult to judge, but fair to say that the Fed still has more work to do here. Turning to the 5-year break-even inflation value as a measure of the market's inflation expectations going forward, it's fair to say the market agrees that there's still a little work to be done. However, this 2.5% number suggests that the Fed mostly retains its inflation-fighting credibility. While the level of interest rates is not more important than employment or prices, mid-4% is high given recent history, but pretty normal over the longer-term history of interest rates. The next couple charts will put those figures into perspective. As noted, unemployment is still historically low, but more recently coming off its nadir. Core inflation measures continue to fall, yet remain above the 2% target. The 10-year benchmark Treasury rate is higher than recent history, but sitting about where it was in the late 2000s. Finally, let's take a look at how interest rates have moved. On the short rate side, we see the rapid tightening of monetary policy over 2022 in the 3-month rate, which has leveled out above 5%. Below that, we see the now negative spread between the 2-year and the 3-month rate, indicating the market's expectation for future rate cuts. More recently, we've seen that spread narrow some, indicating a moderating of that expectation. Intermediate and long rates also rose in anticipation of the tightening. The 2-year, 10-year spread has moderated some, and the long-year spread is essentially flat. Reinforcing the time series picture, we can also examine how yields have moved across the curve over the past year. As this illustration shows, moving red to blue, rates have risen pretty substantially over that time frame and across the curve, but mostly in the longer dated maturities. Finishing up with real yields, we can see they are now sitting at 2%, well above the negative territory they were in during the pandemic. Break-even inflation measures have come down from their highs in mid-2022 during the midst of inflation and are now sitting slightly above the Fed's 2% target. That's it for now. Thanks for watching. I hope it was helpful.